Hi all, welcome to lecture number 2 of IDT for November 2020. We were in framework of GST as introduced in India. So we have discussed dual GST model. Now second one was CGST, SGST, UTGST, IGST. That is GST was a destination based tax. So we will look at the place of supply, and if the location of the supplier and the place of supply is in same state, we will be charging CGST plus SGST. And if it is in both are in different states, we will charge IGST. We have discussed that concept. Now the third point is the legislative framework. So from here we have to continue. There is a single legislation CGST Act for levying CGST. Similarly, union territories without legislature, Andaman and Nicobar, Lakshadweep, Dadra and Nagar Haveli, Daman and Diu, Chandigarh. So there were actually 7 union territories, but out of the 7 union territories, 5 union territories have their own have without legislation, and whereas 2 union territories, that is Delhi and Puducherry, that is Delhi and Puducherry, they have their own GST legislation. So even that 2 union territories will be charging SGST, but whereas other union territories will be levying UTGST plus CGST. Though there are multiple SGST legislation, the basic feature of law, chargeability, definition of taxable event, taxable person, classification and valuation of goods and services, procedure for classification of levy of tax, and like are uniform in all the SGST legislations. Not much important. Now, classification of goods and services. So, how do we charge a rate of tax for an item? Say, in the previous lecture, I have given an example of purchasing address. So how to determine the rate of tax for that? So for that, there is a HSN code. So HSN means harmonized system of nomenclature. So there is an HSN code. Say it's a tariff. So tariff means actually a rate. So in a particular book, all the 8 services or goods and corresponding codes and the corresponding rates has been mentioned. So what rate is corresponding to that HSN code that is applicable for it. So they have listed down all the possible activities and all the possible goods and services, and for that HSN codes has been assigned. So the rate corresponding to those HSN codes we have to apply. Composition scheme. So what is composition scheme? So we have discussed the concept of GST at each stage. We have discussed the stage at each stage value added is being taxed. But so this system requires accounting, then maintenance of all data, invoices, then filing of returns, etc. So for a small taxpayers, a small businessmen, the accounting of all the invoices, say purchases, sales, expenses, all the expenses accounting is actually cumbersome. So in order to provide relief to small businessmen, they have introduced composition scheme. So what is in this composition scheme? So they need not charge GST on the invoices. So for example, I am a retailer, I sell dress. So I have to collect GST and I have to remit to the government. So in composition scheme, I should not collect GST. And I have purchased it from an wholesaler. He should, I will have paid to him, but I cannot take the credit. I have discussed the term credit. That means tax paid at an earlier stage is allowed to set off against current stage. So that is actually credit means. But I cannot take the credit. I cannot charge GST. And what I should do from my own pocket, I should pay a fixed percentage, say 1% or 5% or 6%. I should pay. I should pay to the government directly. So it is an out-of-pocket expense. If I am paying it from my own pocket, no need to maintain a records of the all the invoices and everything. Okay, I need not maintain the list of inventory. So there is some benefits given to composition scheme. However, for providing relief to small businessmen, primarily manufacturers, suppliers of food articles, traders, etc., making intrastate supplies, a similar method of paying tax is prescribed, known as composition levy. So this is actually a detailed chapter is coming over us. So this is just an introduction. Next, registration. So we know that registration is important. Why? Because, say for example, when GST was introduced, there are many newses that people without GST registration was collecting taxes in the name of GST. So what happens in such cases? In such cases, people or the businessmen without GST registration, they collect the tax from the people and they put it down their own pocket. They won't remit it to the government. So they do fraudulent activities in the name of government. So in order to streamline this situation, government has come up that only people who have registered with the GST department, so they will be getting a GST registration number. It is actually a 15-digit number. So GST registration, those who have GST registration number, they can only collect GST. Okay, so registration is mandatory to collect GST. So every supplier of goods and services is required to obtain registration in the state or union territory from where he makes taxable supply if his aggregate turnover exceeds the threshold limit. Now, we have discussed registration is important, it is mandatory to collect tax. Now, who is required to take registration? There is a separate chapter known as registration. I will just give a brief outline. So, who are required to collect? Who is required to register? So, every and where is it a pan India basis single registration or in each and every state I have to make registration? The answer is I have to take registration in each and every state. It is actually a state based registration. I have to register in every state from where I make a taxable supply. There are taxable supply as well as exempted supplies. What do you mean by exempted supply? Exempted supply means supplies which are exempted from tax. Those supplies they do not we need not charge GST. They are exempted from GST. So if I am making a taxable supply, say from Kerala, then I have to get registration in Kerala. But this is not necessary that with 1 rupee or 10 rupee or 1 lakh rupees, I have to take registration. There is a threshold limit applicable, say 20 lakhs or 40 lakhs. So those specific threshold limit is applicable in each and every, not in each and every state. That threshold limit is applicable. So if my total turnover all India basis, if my turnover all India basis exceeds the specific threshold limit, then I have to take registration. So maybe I am a businessman having business in different parts of the country. Then I have to take registration in all the states from where I make a taxable supply. We will come upon this in the next chapters, but this is just a simple idea. State with threshold limit of 10 lakhs, state with threshold limit of 20 lakhs for goods and services, state with threshold limit of 20 lakhs for services and 40 lakhs for goods. So this is a simple diagram. More details are coming in the coming chapters. So there are threshold limits of 10 lakhs, 20 lakhs as well as 40 lakhs. Next, exemptions. What do you mean by exemptions? So we have seen compositor scheme. It is actually a relief given to small businessmen. Apart from that, there are exemption notifications. So government release notifications, and by notification they will exempt say goods or services from GST. So that means those service providers or suppliers who are selling or who are supplying these specified goods or services, they need not charge GST on their invoices, they need not collect GST, and they need not remit it. So there is no GST for those services or those specific goods. Seamless flow of credit. Seamless flow of credit, we have discussed the term credit in the earlier lecture. So I have paid tax in an earlier stage, and in the subsequent stage I can set off it against the tax collected. So since GST is a destination based consumption tax, revenue of SGST ordinarily accrues to the consuming states. The interstate supplier in the exporting state is allowed to set off the available credit of IGST, CGST, and SGST in that order. against the IGST payable on interstate supply. We have seen that, so for example, in an intrastate supply, we charge, say I am a supplier and I am selling a good. So so outwardly we see that, say if we go to a shop, we purchase an item, the supplier is a shopkeeper and we are the recipient. So the shopkeeper issue an invoice. So along with the goods, he gives us an invoice. In that invoice, they charge the price of the goods as well as they charge GST. And what GST they charge? They won't charge GST 18 percentage. They charge say CGST 9 percentage, SGST 9 percentage, or they charge IGST 18 percentage. So we have discussed, if it is an intrastate supply, they charge CGST plus SGST. So if it is a CGST, SGST 9 percentage, 9 percentage they charge. Okay, so that is from the perspective of the supplier, that is his outward supply. What do you mean by outward supply and inward supply? Outward supply means he is supplying goods. Inward supply means he is receiving goods. It is inwards. Outward is going out. So he is selling goods. So he issued invoice, he charged GST, he collected GST. That is his outward supply. Now, in order to purchase this item, he has some other supplier has already issued him invoice, and they might have charged CGST, SGST, and our supplier has paid GST. So that is his input tax credit. That is his input tax credit. That is he already paid at an earlier stage. So now the other supplier might have also charged CGST 9 percentage, SGST 9 percentage. Now here we have to set off the credit against the output tax liability. So how? CGST, SGST output liability is there, and CGST, SGST input liability is there. So we can set off CGST against CGST, SGST against SGST. And here comes an important thing. The interstate supplier in the exporting state is allowed to set off the available credit of IGST, CGST, and SGST against the IGST payable on interstate supply. Suppose I say I supplied goods, it is actually an interstate supply. So in case of interstate supply, I charged IGST invoice. Okay, I issued IGST invoice. So IGST outward supply. Now I have to remit IGST to the central government. Now I have credit, but what credit I have is I might have IGST, I might have CGST, SGST. So whether I can set off CGST, SGST against IGST? Answer is yes. In which order I have to set off? Against IGST, I have to first set off IGST, then I have to set off CGST, then I have to set off SGST. Now, the buyer in the importing state is allowed to avail the credit of IGST paid on interstate purchase made by him. Thus, unlike the earlier scenario where the credit chain used to break in case of interstate sales on account of non-vatable CST, under GST regime there is seamless flow of credit. So we have discussed in the earlier tax regimes of VAT and service tax, central government taxes was not able to be set off against state government taxes. But here, even against central government taxes, say IGST I have to pay to the central government, SGST I have to pay to the state government, but still against IGST I can set off SGST. And vice versa, against CGST I can set off CGST and IGST. Against SGST, I can set off SGST and IGST also. But most important thing, I cannot set off CGST against SGST, or I cannot set off SGST against CGST. Most important thing, please mark it. Now, this is an illustration. So what transaction I have depicted, this is summarized in this illustration. Let's discuss this illustration. In case of local supply of goods or services, the supplier would charge dual GST, that is CGST and SGST. So we have discussed, in case of intrastate supply, the supplier will charge CGST and SGST. Say for example, the value is 10,000 rupees, 900 rupees, 9% CGST, 9% SGST. Total price charged is, so invoice value will be 11,800, and the recipient should pay him 11,800 and purchase the goods. And CGST, SGST charged on B for supply of goods will be remitted by A to the appropriate account of central government and state government. So this 900 rupees, this supplier will be paying to the central government since it is CGST, and this 900 he will pay to the his state government. So 900 rupees. Now this is his outward liability. He has nothing to set off because this is the first stage. So he has not paid any tax in the earlier stage. So he cannot set off any input tax credit. He have to remit this 900. Now, in stage 2, supply of goods or services by B to C, value addition 20%. So this is second stage. In second stage, he purchased for 10,000. 10,000 was the price of the goods. Now added 20%. He did some adjustments. His profit also included, and he sold the goods for 12,000. And out of this 12,000, again it is an intrastate supply. He charged a GST. How much? 9% GST, 9% GST. Total 14,160. So this is stage 2. In stage 2, how much he is required to pay to the government? He collected 1080 CGST, and against the CGST he is able to set off the CGST credit. That means input tax credit availed at earlier stage 900. So how much he paid to the central government? 180. And against SGST 1080 less 900, 180. So he is required to pay to central government 180 and to state government 180. So what is this 180? It is 20%, say 200. 200 was the value addition. 200 into 9%, that is not 200, sorry, 2000. 2000 into 9%, 180 rupees. Now, how much each state government and central government received in net effect? So central government at the first stage we paid 900 each, and in second stage we paid 180 each, and total 180, 1080. So the state government and central government received total taxes, and the burden was borne by the final consumer. The supplier, who was an intermediary, he just collected and remitted. He has no profit or no loss. So we discussed intrastate supply. Now interstate supply. What happens in case of interstate supply? In case of interstate supply, say for example, in stage 1, it is actually an intrastate supply. In stage 1, it is intrastate supply. So 10,000, 9% CGST, 9% SGST, total 11,800. And he remitted to central government and state government. Since this is the first stage, he has no tax credit to set off. Now, in second stage, it is actually an interstate supply. 20% of the value addition is there, so 12,000 rupees is the price of the goods. He should charge IGST. Why? Because from one state, he cannot, when he is selling to another state, he cannot collect tax of those state and pay to that state because he is registered in his state. So what we have to do is, for any interstate supply, we will be directly paying to the central government. Okay, now central government, after receiving all the taxes, they will they will transfer the funds to corresponding state governments. So that is not our business, that will be dealt in the government level. So 12,000, 18% IGST. So he is charging 18% IGST. So 2,160. Now 2,160 is the IGST payable. Now, what credit he has, what tax he paid in the stage 1 is CGST, SGST 900. Is he able to set it off against IGST? Answer is yes. So, against this IGST, in what order he should set off? He should set off first IGST. Whether he has any IGST credit? No. Then second CGST credit? Yes. Then against SGST credit? Yes. So, balance paid to be central government 360 rupees. Now, The most important thing is what happens at the back end. In the back end, we have in the stage one, our supplier paid to the central government 900 rupees. Now we used that to set off against the IGST payable, that is, which is payable to the central government. Now, what our state government has to do? Our state government has to transfer this fund to the central government. So the IGST charged on B of state 2 will be remitted by A of state 1 to the appropriate account of central government. State 1 will transfer SGST credit 900 utilized in the payment of IGST. So this SGST will be transferred from that state government's fund to the central government fund. Now, again another third stage is coming. In this third stage, again there is an intrastate supply. Okay. Now in the third stage, again this goods is further sold, say after a valuation of 20%. Now in this stage, it is an intrastate supply. So intrastate supply, what we will charge? We will charge CGST, SGST. So again, 20% valuation is there. The price of the goods came to 14,400. We will be charging 9% CGST, 9% SGST. Okay, and 1,296. So against the CGST, SGST, the second stage person, he collected it. Now what he have paid? He have paid IGST. So that tax credit he can avail and he can adjust it against the CGST and SGST. So how? So CGST payable 1296 we have seen. Credit of IGST. How much IGST was there? IGST credit was actually, if you see, IGST was 2160 he paid. But 2160, so here only 1296 is there. So we will set off maximum possible 1296. Then SGST payable 1296. How much we will set off? We will set off balance remaining 2160 of 864, and balance we will be paying to the state government. Now, so IGST credit was there. IGST credit. So how we should utilize IGST credit? IGST credit first we will utilize against IGST itself. So IGST credit should be first utilized against IGST, and if there is any balance remaining IGST, we can set it off against CGST or SGST in any manner, no issues. So here we have set it off against CGST, then we have set off against SGST. In any manner, we can adjust it. So SGST payable to state government 432. So we will be paying it to 432 to state government. Now we have seen that we have utilized IGST 864 against tax payable to state government. So in this stage, what happens? Now this state government, so the central government has to transfer 864 rupees to the state government. Now, at the end of it, at the end, what happens to the revenue? Whether the government received, the state government received the total revenue. So we have seen in stage one, 900 is received by central government and state government. In stage two, 360 rupees. So we have seen, we set it off, and 360 rupees, what happened? We paid to central government. Then state government transferred 900 rupees to central government. We have seen, because it was IGST and we used CSGST to be set off. Now in last stage, it is again stage 2, a different state came. Stage 2 we paid to state 2 432. Now from the central government fund we remitted to state government fund 864. So at the end 1296 is received by central government and 1296 is received by state government. So equally 9%, 9%, both central government and state government received. So you have to go through this illustration once again. So this is a brief scenario of how output tax is collected, how tax in the earlier stage is used to set off against the current tax payable, that is input tax credit, and how government transfer the funds, say state government or central government transfer fund to corresponding state government, transfer of the credit. and balance how revenue is shared between central government and state government. This is the crux of GST. Now, GST Common Portal. What is Common Portal? So we require an interface, a website for filing the returns, for taking registration, a platform for clearing all our doubts and compliance procedures. So that is our GST Common Portal. And what is the name of the website? www.gst.gov.in. It is a website managed by GST Network, GSTN, and GST Network, GSTN is managing this our GST portal. And this GST Network, it is a company incorporated under Section 8 of the Companies Act. So Section 8 company, non-profit organization, Section 8 company. So this is our GST website. If you go to www.gst.gov.in, you can see this interface. And there is something known as e-Waybill. E-Waybill is actually a document which is issued for transportation of goods. So goods should be legally moved from one place to another. So in order to affirm that the goods are legally moved, so we have to go to this website www.ewaybillgst.gov.in, and then you have to register there, and we have to generate an e-way bill, and that e-way bill should be along with the goods. So it affirms that the movement of goods is legal. Now, GSP and ASP. What is GSP and ASP? GSP is GST Suvidha Providers, and ASP is Application Service Providers. So, who are GSP and ASPs? So, actually, if I'm a big businessman and I have a lot of invoices, say I have 1 lakh or 2 lakh transactions in each month, loading all the data, all the relevant informations into the website creates problems to the website. So, the website will be blocked due to the excess consumption. So we have, in order to simplify that, we have GST network has selected certain ITs, ITEs and financial technology companies. So it's a big force, some IT tech companies. So they are, government has selected them as GST Suvidha providers. Now what they can do, they can develop their own applications or their own platforms, and from in that platform they can maintain their own methods, and they can import data into their platform, and from them, their platform, they can get direct access to GST website. So if each businessman or each say company, they directly visit the company's the GST website, the site will get damaged. So in order to avoid that direct traffic, GST and the cumbersome procedures, this GST Suvidha providers, they have their own applications. So they collect our company's data, they load it to their server and in a particular format, and then they upload it to the GST portal. So they can customize the data in particular form. So there's actually a fixed format, but this GST Suvidha providers, they have their own formats so that we can load the data easily. Next, GST compensation cess. What is GST compensation cess? So there is a GST compensation to state cess Act 2017. We have seen CGST Act, SGST Act, UTGST Act. We know that these are formed to levy taxes. Now, GST compensation to cess Act 2017. This act is also formed. Why this act is formed, and on what products this tax is imposed? This tax is imposed on luxury items or demerit goods like pan masala, tobacco, aerated water, motor cars, etc. So on luxury items and demerit goods or sin goods, this GST compensation to cess tax is levied. And why it is levied? It is levied on intrastate supply and interstate supplies. It is with a view to provide for compensation to the states for the loss of revenue arising on account of implementation of GST. So due to implementation of GST, sometimes some state government might have lost the revenue. We have seen service tax was paid to central government, VAT was paid to state government, central excise duty was paid to central government. So now both central government and state government can simultaneously levy charges. So if because of due to this change, if the state government is losing a revenue, then the central government will compensate the government say for 5 years. How they will pay this compensation? How much revenue is lost by the central government? They will pay it to the state government. How central government will pay? They imposed another tax, GST common services, and they collected tax from the public, and then they used this common services to compensate the state governments. Now, GST is a tax on goods and services. So GST goods and service tax. So GST is imposed on goods as well as services. So what's the difference between goods and services? So basically movable items. So for example, I purchased a glass, I purchased a dress. It is actually goods. Then what is services? Say I went into a restaurant and I had food. That is actually a service. I went into a theater, I watched a movie. It's actually a service. I went into water theme park. So actually it's a service. So GST is levied on goods as well as services, except alcoholic liquor for human consumption and petroleum crude, diesel, petrol, ATF, and natural gas. So GST is not levied on two items, two broad items. What is it? One, alcoholic liquor for human consumption. Why alcoholic liquor for human consumption? So whether there is any GST? So there is no GST and alcoholic liquor. So we have seen earlier on alcoholic liquor, actually it is state excise duty. So we know that state government gets the revenue. So in TV news we see that government due to liquor sale, state government received so much of revenue. So why? Because state excise duty is levied on alcoholic liquor. Even after GST is introduced, state excise duty remains to be levied on alcoholic liquor for human consumption. So on alcoholic liquor, so we see that state excise duty from on manufacture. Excise duty was on manufacture, and for sale it is VAT. So state excise duty and what is still levied on alcoholic liquor. Now what happens on petroleum crude, diesel, petrol, ATF, and natural gas? On petroleum crude, diesel, petrol, ATF. ATF is our turbine fuel, which is used in aeroplanes and all, and natural gas. On those items, it is central excise duty. Okay. So their GST will be levied on later date. So till such a date, central excise duty and CST or what is levied. So it is still, so still tax is there, and it is not, the tax is not GST, it is central excise duty. For alcoholic liquor, it is state excise duty. Now tobacco products. But tobacco products, it is not mentioned earlier. Why? Because for tobacco, GST is applicable. But the most important thing is that tobacco is within the purview of GST. For tobacco is subject to GST as well as central excise duty. So tobacco, GST is charged as well as central excise duty is charged. Now, real estate sector has been kept out of ambit of GST. That is, GST will not be levied on sale or purchase of immovable property. So, real estate sector. So, say for example, if we are going to purchase a house or a flat, say for example, a flat. So, if it is an already fully furnished, fully completed flat, we are purchasing it. So, when we are purchasing it, there is no GST applicable on such sale of immovable property. But suppose during the construction itself, if we are booking a flat, then it is actually not a sale of flat, it's actually a works contract. So the GST will be applicable. But if a completed flat is sold and if we are purchasing it, no GST is applicable. Now, what are the taxes subsumed in GST? So we know that due to the introduction of GST, lot many taxes has been subsumed. What taxes has been subsumed? Say central excise duty, additional excise duty, service tax, excise duty under Medicinal and Toilet Preparation Act, CVD and special CVD, central sales tax, central surcharges, then state taxes, state surcharges such as entertainment tax, except those levied by local bodies. This is an important thing because local bodies still levy entertainment tax. So if we go to the theater and all, if we see the cinema ticket, there is actually entertainment tax which is levied by local bodies. Then tax on lottery betting gambling, entry tax, VAT or sales tax, luxury tax, tax on advertisement. These taxes are no longer. So all these taxes has been abolished, and what has been introduced? GST has been introduced. So pre-GST indirect tax structure, GST structure in India. Central taxes, multiple state taxes, earlier it was there. Now single tax administration, uniform law. So one nation, one tax, one market. That is actually the motto of GST. Now GST, we charge CGST or SGST, CGST plus SGST, or we charge IGST. So dual model GST structure. Now the summary: alcohol and liquor for human consumption, it is not in the under the ambit of GST. It's still state government has the power. Then petroleum products, crude oil, diesel, petrol, natural gas, ATF, it is central excise duty is still leviable. Now entertainment tax, it is with the local bodies. Tobacco, it is within the purview of GST, both GST as well as central excise duty is levied on tobacco products. Now, what are the benefits of GST? It's actually a general question. What are the benefits? So, benefits to the economy, creation of unified national market. So, one nation, one market. That is the benefit of GST. Then boost to Make in India initiative. To Make in India initiative. Then enhance the investment and employment. So, investment job opportunities will increase. Then simplify the tax structure, ease of doing business. So there is no much complication. Both central government and state government levy taxes, ease of doing business. Then certainty in tax administration. So tax administration becomes much simpler. Then automated procedures with greater use of IT. So we have already discussed, we have created GST network. So GST network, Section 8 company. So they are maintaining GST portal. So IT facilities are introduced. So automated procedures are there. Then reduction in compliance cost. So compliance procedures are very lower. Then benefits to agriculture and industry. Then mitigation of ill effects of cascading. Cascading effects has been, so tax on tax is cascading effect that has been abolished. Now benefits to small traders and entrepreneurs. So composition schemes has been introduced for small taxpayers. So all these are benefits of GST. So to economy, to simplified tax structure, tax compliances, trade and industry benefits. Now, constitutional provisions. So we know that Constitution of India. So Constitution of India contains various articles. So in these articles, they have constituted the law. Okay. Now a tax can be introduced only if it is possible, only if it is permitted under the constitution. So constitution has to be redrafted, or constitution has to be amended to introduce this GST law. So they have amended various provisions of the Constitution of India, and they introduced this GST. So we know that the Constitution of India is a supreme law of India. It consists of preamble, 25 parts containing 448 articles and 12 schedules. So preamble, while studying in school, we have seen in every textbook of NCERT, this left page, there is a preamble of Indian Constitution. Now, in con so in act we have see section 1, section 2, section 3, but in constitution it is not section, it is actually article 1, article 2, article 3, article 448. We have seen article 15. There's a film called article 15. Then article 370. So such articles are there. So those articles are there. So related to tax, so the constitution contains articles related to, say, right to equality, we have seen. So similarly, related to tax structure, there are different articles. What are the articles? Article 265, article 245, article 246. So those articles were there which is related to tax. What is article 265? Article 265 says that no tax should be levied except by authority of law. Only if there is a law which is permitting collection of tax, then only tax should be levied or collected. So Article 265 restrict people from collecting tax simply. They should collect tax only if it is permitted by law. Then what is Article 245? Article 245 says that relationship between union and state. The power for enacting the law is conferred on the parliament and on the legislature of a state by Article 245. Subject to the provisions of the Constitution, Parliament may make law for whole or any part of the territory, and the legislature of state may make law for the whole or any part of the state. So, Article 245 gives the power. Say the Parliament can make law for full country, and the state can make law for the state. So that is permitted under Article 245. Now under Article 246. So Article 246 it gives authority to union and state government for levying tax. So Parliament can make law for all of India. State legislature can make law for all or part of the state. Now in Article 246, there is a list 1, list 2, list 3. So that is list 1 is union list. What's it? Union list is a list. There is a lot of taxes mentioned. So Parliament or central government can deal with this list. Now list 2 is state list. So there are a lot of taxes in state list. So in state list, only state government can frame rules. In list 3, it is concurrent rules list. In concurrent list, both central government and state government can deal with. Now, income tax is levied by virtue of entry number 82 and customs is entry number 83. Okay. So we have seen in list 1, you only central government can levy. List 2, only state government can levy. List 3, concurrent list, both central government and state government can levy. And we have seen entry number 82 to 91 of list 1 enumerate the subjects where central government has to levy taxes. So entry number 82 and entry number 83 of list 1, so only levied by central government, that is income tax and customs. So we know that income tax we pay to the central government and not to the state government. Customs duty we pay to the central government and not to the state government. Now Article 246A. So there was Article 246. Now amendment has come and Article 246A has been introduced. What is Article 246A? Power to make law with the GST. So GST 246A, who can make law with corresponding to GST? So notwithstanding anything contained in 246, legislature of every state has the power to make law with respect to GST imposed by the union or such state. So in state government has the power and parliament has the power to make law with respect to GST, where supply of goods or services takes place in the course of interstate trade or commerce. So in case of interstate trade or commerce, parliament can make the law, and in case of intrastate supplies or state government state limit, state government can enumerate the matters. It is Article 246A. So both central government and state government has been given the power to frame rules. Now Article 269A. So 269A again introduced in Constitution. What is levy and collection of GST on interstate supply? So they are levying tax on interstate supply. We know that for intrastate supply, CGST, SGST, and interstate supply it is IGST. So Article 269A stipulates that GST in the course of interstate trade should be collected by Government of India, and it should be apportioned between union and state in the manner provided by Parliament. So if it is an interstate supply, the tax will be collected by the central government and it will be apportioned between central government and state government as per the specified manners. Now, definition of goods and service tax, services, states are incorporated in Article 366. So in Article 366, they have introduced some definitions. So what is goods and service tax? What is service? What is a state? So those definitions has been introduced in Article 366. The most important is Article 279A. So in the amendments of the Constitution, the most important one is Article 279A, GST Council. So in the newspapers and the TV, we have seen GST Council meeting was there. So Nirmala Sitharaman headed the meeting. So all lot of decisions has been taken in the GST Council. Those news we hear in the television as well as newspapers. So who is GST Council? Article 279A of the Constitution empower President to constitute a joint forum of central and state. So both central government and state government collaboration. So that is actually GST Council. So President will constitute the GST Council. So President constituted GST Council on 15 September. Now, who is the head of this council? The Union Finance Minister is the chairman of this council. So the chairman of the GST Council is Union Finance Minister, Honorable Madam Nirmala Sitharaman. Now, and ministers in charge of finance or taxation or any other minister nominated by each of the state and unitary with the legislature are its members. Besides, the Union Minister of State in charge of Revenue or Finance is also its member. So Nirmala Sitharaman, our Honorable Union Finance Minister, is the chairman. Then one member from Union. So the Union Minister, that is our Anurag Singh Thakur, he is the Union Minister of State in charge of Revenue. He is a member. Then from each state government, say minister in charge of finance, the finance minister or any other minister, they will be member in this GST Council. Say for example, from Kerala, Honorable Finance Minister Thomas Isaac, he is a member of GST Council. Now, the function of why GST Council is constituted. The function of GST Council is to make a recommendation to the union and states on important issues like tax rates, exemptions, threshold limits, dispute resolution, etc. So on all matters, on all disputes, on all tax rates, exemptions, so extensions, so everything, this GST Council will be making the recommendations or decisions. So this is all about our chapter. If you see the test your knowledge questions, you can just go through these questions. All the questions, all the important concepts has been discussed. So this is actually the concept of basic idea of GST. Now on further chapters, we will be going deeper and deeper into the chapter.